Hello everyone, welcome to the 218th episode of me. In the last episode we went through top 5 books for beginner Forex traders, so currency trading for dummies. So we went through not 5 different books, but more than 5, but some books are based off of the books listed, if that makes sense. So we've got currency trading for dummies, day trading and swing trading the currency market, Japanese candlestick charting techniques, and along with that is the candlestick course, Beyond Candlesticks, New Japanese Charting Techniques Revealed, Strategies for Profiting Japanese Candlestick Charts. And then we've got How to Make a Living Trading Foreign Exchange and Forex Trading, the Basics Explained in Simple Terms. And I think in the last video, as I was reading through the descriptions of the books, I decided that the Currency Trading for Dummies and the Forex Trading, the Basics Explained in Simple Terms, either of them could be the first ones to read for the books. And then we went through the Mastering Short-Term Trading, so recognizing the right trade would mean the difference between a good potential situation and ones to avoid. The market has already reacted by the time you hear about the financial news. Some basic steps to find the right trades for the right times at the right time. So step 1, watch the moving averages. Moving averages is the average price of a stock over a specific period of time. Overall idea is to see if the stock is trending upward or downward. Step 2, understand overall cycles or patterns. Generally the market trades in cycles, so watch the calendar at particular times. Cycles can be used to your advantage to determine good times to enter long or short positions. Step 3, get a sense of market trends, so when the overall market trend is against you, the odds of having a successful trade drops. Now we're on to the controlling risk. So, controlling risk is one of the most important aspects of trading successfully. Short-term trading involves risk, so it is essential to minimize risk and maximize return. This requires the use of sell stops or buy stops as protection from market reversals. So stop losses. Sell stop is in order to sell the stock once it reaches a predetermined price. Once this price is reached, it becomes an order to sell at the market price. A buy stop is the opposite. It is used to short position where the stock rises to a particular price, at which point it becomes a buy order. So I think for this bit, because I'm not sure if this article's focused around, I think it's focused more around stock trading rather than the actual forex trading. So the sell stop and buy stop, I know it is a thing in forex. I think it is. So let's call it buy stop. Yeah, so opens a long position on the market when it hits a specified price above its current price. So use sell stops and buy stops as protection from market reversals. Sell stop is in order to sell a stock once it reaches a predetermined price. Sell stop, an order to sell a stock once it reaches a predetermined price. Buy stop, when the stock rises to a particular price at which the point becomes a buy order. So use a short position where when the stock price rises to a particular price, specific price at which it becomes a buy order. So sell stop is used in a long position when the stock price drops to a specific price at which it becomes a sell order. I'm going to reword this one. In order to sell a stock once so used in a long position when the stock price falls to a specific price at which it becomes a sell order. Okay. Both of these are designed to limit your downside. As a general rule in short-term trading, you want to set your sell stop or buy stop within 10 to 15% of where you bought the stock or initiated the short. The idea is to keep losses manageable so gains will be considerably more than the inevitable losses you incur. So, as a general rule, you want to set your sell stop or buy stop within 10 to Set your buy stop and sell stop within 10 to 15% of where you bought. 10 to 15% of where you bought or initiated the short trade. So when you start buying or selling, bought the stock or initiated the short trade. The idea is to keep losses manageable so gains will be considerably more than the inevitable losses you incur. Okay, technical analysis. There's an old saying on Wall Street, never fight the tape. Whether most admit it or not, the market's always looking forward and pricing in what is happening. Never fight the tape. Whether most admit it or not, the market is always looking forward and pricing in what is happening. This means that everything we know about earnings, company management, other factors is already priced into the stock. Staying ahead of everyone else requires that you use technical analysis. It is already priced into the stock. The market is always looking forward and pricing in what is happening. This means that everything we know about earnings, companies management, other factors is already priced into a stock. This means everything known about earnings, company management, and other factors is already priced into the stock. Staying ahead of everyone else requires that you use technical analysis. Okay. Technical analysis is a process of evaluating and studying stocks or markets using previous price and patterns to predict what will happen in the future. In short-term trading, this is an important tool to help you to understand how to make profits while others are unsure. Below, we want to cover some of the various tools and techniques of technical analysis. Buy and sell indicators. Several indicators are used to determine the right time to buy and sell. Two of the most popular ones include the Relative Strength Index, RSI, and the Stochastic Oscillator, which we've gone through before. The Relative Strength Index compares the relative strength or weakness of a stock compared to the other stocks in the market. Generally, a reading of 70 indicates a topping pattern, while a reading below 30 shows that stock has been oversold. However, it is important to keep in mind that prices can remain at overbought or oversold levels for a considerable amount of time. Overbought, oversold. The stochastic oscillator is used to decide whether a stock is expensive or cheap, based on the stock's closing price range over a period of time. Reading of 80 signals the stock is overbought, expensive, while a reading of 20 signals the stock is oversold, inexpensive. RSI and stochastics can be used as stock picking tools, but you must use them in conjunction with other tools to spot the best opportunities. So you need to use other tools to verify the stochastics and the RSI. And also, if it's oversold, it's inexpensive because there's more supply than demand. So there's more supply than demand, then the price is going to go down. So it's cheap. And then if it's overbought, so if the stock is overbought, then there's more demand than supply. So the stock is expensive. Because if there's more demand than supply, then the price goes up, so it's expensive. Patterns. Another tool that can help you find good short-term trading opportunities are patterns in stock charts. Patterns can develop over several days, months, or years. While no two patterns are the same, they can be used to predict price movements. Several important patterns to watch for include head and shoulders. The head and shoulders, considered one of the most reliable patterns, is a reversal pattern often seen when a stock is topping out. Head and shoulders, I know we've gone through this before. So, yep. Shoulder, head, shoulder. So reversal pattern, so triangles. Three types of triangles: ascending, descending, symmetrical. Triangle is formed when the range between the stock's highs and lows narrows. This pattern often occurs when prices are bottoming or topping out. As prices narrow, this signifies the stock could break out to the upside or downside in a violent fashion. Important patterns to watch out for. What was that? There's emoji coming up. Head and shoulders. Head and shoulders considered one of the most reliable patterns is a reversal pattern often seen when the stock is topping out. A reversal pattern seen when the stock is topping out. Triangles. So triangles formed when the range between a stock's high and low is narrowing. Pattern often occurs when prices are bottoming or topping out. Pattern often occurs when prices are bottoming or topping out. As prices narrow, this signifies the stock could break out to the upside or downside in a violent fashion. As prices narrow, signifies the stock could break out to the upside. As prices narrow, it could signify the stock breaking out to the upside or downside in a violent fashion. So in a big rally basically. Double tops, seen this one before again. Double tops occur when prices rise to a certain point on heavy volumes, retreat and then retest that point on decreased volumes. This pattern signals the stock may be headed lower. Occurs when the prices rises to a certain point on heavy volumes. Occurs when prices rise to a certain point. Price rises to a certain point on heavy volumes. Retreat and then retest that point on decreased volumes. Pattern signals the stock may be headed lower. This pattern signals that the stock may be headed lower. Double tops. So double bottoms signals that it's going to be a downward trend basically. Double bottoms. Reverse for double top. Prices will fall to a certain point on heavy volume. Prices will fall to a certain point on heavy volumes. Can't spell. Rise before falling back to the original level on lower volume. And then rise before falling back to the original level. The original level on lower volume. Unable to break the low point, this pattern signals the stock may be headed higher on lower volume. So this pattern signals that the stock may be headed higher, so upward trend. The bottom line, short-term trading uses many methods and tools to make money. The catch is that you need to educate yourself on how to apply the tools to achieve success. As you learn more about short-term trading, you find yourself drawn on to one strategy or another before settling on the right mix for your particular tendencies and risk appetite. The goal of any trading strategy is to keep losses at a minimum and profits at a maximum, and this is no different for short-term trading. Okay. An introduction to trading Forex futures. Is this relevant? Am I going to be trading futures? I'll leave that one alone for now. So let's go back to the trading section and work through it in order. So I remember reading through all of these, mastering short-term trading. So that's the one we just done. Yep, so we stopped there. Best dividend stocks for August 2024, not really relevant. Frequent asked questions, what do brokers charge to trade? Okay. Key terms, right, here we go. Trading, how to trade Forex. I think we've done this one. This looks very familiar, yep, done this one. How to trade options on Robinhood. How to trade options on Webull. How to trade ODTE options. How to open a swing trade account. Okay, so explore trading all. See all. How to buy Dogecoin. How to swing trade. Yeah, it's kind of relevant. Stock screeners. Okay, so this is all stocks and stuff as well, so oof. How to buy SafeMoon crypto, 4 best futures trading platforms. Dunning-Kruger effect, meaning, examples in finance. Interesting. How to buy Shiba Inu. How information bias can lead to poor investing decisions. Robinhood versus eToro 2024. Dunning-Kruger effect, means, examples in finance. You know what, this is a kind of interesting article actually. Let me just read this. So Dunning-Kruger effect, meanings and examples in finance. What is the Dunning-Kruger effect? The Dunning-Kruger effect is a cognitive bias first described by the psychologist David Dunning and Justin Kruger in 1999. It occurs when people with low levels of knowledge, skill, or competence in a particular field overestimate their own ability and knowledge. Justin Kruger and David Dunning via APA, American Psychological Association. Unskilled and unaware of it, how difficulties in recognizing one's own incompetence lead to inflated self-assessments. Interesting. Yep, so overestimate their own ability and knowledge. Yep. Put differently, people who don't know what they're talking about tend to incorrectly think they do know what they're talking about. Put differently, people who don't know what they're talking about tend to incorrectly think they do know what they're talking about. At the same time, experts in a field may underestimate their own knowledge and competence. This part of why Dunning and Kruger's findings are similar to imposter syndrome, whereby high achievers begin to doubt their own abilities. In finance and investing, people who overestimate their knowledge and ability because of the Dunning-Kruger effect may make unwise or overly risky investment decisions that can result in significant losses. This can happen, for example, when people feel confident in their ability to predict market trends or understand complex financial instruments, despite lacking the necessary expertise. Interesting. Key takeaways: the Dunning-Kruger effect is a psychological phenomenon in which people with low level of knowledge or skill greatly overestimate their perceived skills or knowledge. Those who score the worst on actual performance or knowledge are often the same ones who rate themselves most highly and confident in their incorrect claims. At the same time, those individuals with actual skill or knowledge tend to underestimate their abilities in a phenomenon called imposter syndrome. First described in 1999 research paper, Dunning-Kruger effect has been replicated many times. It can affect many life aspects, including investing decisions, including investing decisions, not investment decisions. Minimizing Dunning-Kruger effect can be achieved through education, training, accepting criticism and feedback, and taking an objective evaluation of knowledge or ability. Why the Dunning-Kruger effect happens? The Dunning-Kruger effect is a thought to occur due to a combination of cognitive limitations and a lack of subjective self-awareness. Individuals with limited knowledge or expertise in a field are often unaware of their own limitations, which can result in an inflated sense of competence. In other words, when someone doesn't know what they don't know, When someone doesn't know what they don't know, they are prone to overestimating their knowledge. Has been described colloquially as dumb people who do not realize they are dumb. Dumb people who do not recognize they're dumb. At the same time, those with more expertise may come to underestimate their abilities as they become more aware of the complexities of their field. Fast fact: the phenomenon was first described in a 1999 study titled Unskilled and Aware of It, How Difficulties Recognizing One's Own Incompetence Leads to Inflated Self-Assessments, by social psychologists David Dunning and Justin Kruger. Another reason for the effect could be a lack of insight or metacognition, which is a capacity to reflect honestly and objectively on one's own skills or performance. If someone consistently overestimates their abilities, they may also be more likely to reject feedback, which can play a role in continued underperformance. If someone consistently overestimates their abilities, they may also be more likely to reject feedback, which can play a role in continued underperformance. In addition, the effect may occur as people use their own subjective criteria for what it means to be good at something, rather than objective, standardized measures. The authors discovered that people with low levels of competence in a particular domain were more likely to overestimate their abilities, while those with high levels of competence were more likely to underestimate their abilities, forming an inverted U-shaped plot. Dunning and Kruger assessed participants' actual and perceived abilities in a disparate range of fields, including humour, logical reasoning, and English grammar. Important: Dunning-Kruger effect is a type of cognitive bias. Many similar psychological-based biases affect financial investors, including representative bias, cognitive dissonance, confirmation bias, attachment bias, home country bias, anchoring bias, and the endowment effect. Well, that's a lot of biases. In the grammar study, college students completed a test on American Standard Written English, then self-evaluated their perceived grammar ability and expected test performance. Those who scored the lowest on the test tended to drastically overestimate their perceived grammar ability and expected test score, whilst those who scored highest tend to underestimate their ability and test score. Comparing self-assessment's subjective ability with actual performance objective ability remains the primary to detect and measure the Dunning-Kruger effect. The 2008 study replicated the original findings, showing that people in the lower quarter in terms of actual performance expected to see results of 60% when they scored only 38.4%. Oof. Of absent self-insight among the incompetent. People in the middle half expected to score 72.6% but actually score 61.7%. Meanwhile, those in the upper quarter expected to score 75.6% and actually scored higher, averaging 84.1%. Several other studies have also replicated these findings across various contexts. Tip: Dunning and Kruger's findings show that as an individual Dunning and Kruger's findings show that as an individual's actual competence increases, the disparity between self-assessment and actual performance decreases, eventually leading to a more accurate assessment. Dunning and Kruger's findings show that as an individual's actual competence increases, the disparity between self-assessment and actual performance decreases, eventually leading to a more accurate self-assessment. Impact of the Dunning-Kruger effect. Dunning-Kruger effect affects individuals across various fields including business, finance, medicine, and politics. Can often lead to a poor decision-making, inefficiency, and other negative outcomes. Dunning-Kruger effect in the workplace. The Dunning-Kruger effect can manifest in the forms of employees taking on tasks beyond their actual skill set, or making decisions without fully understanding the ramifications or possible knock-on effects. Additionally, people who suffer from the effect may reject feedback or constructive criticism because they remain convinced of their own abilities and defend the choices that they have made. This can lead to a lack of growth and development, as well as difficulty working collaboratively with others. One potential pitfall is that hiring managers may erroneously hire bad candidates who appear confident during the interview process but are actually victims of the Dunning-Kruger effect. Similarly, promotions may be handed out to those types of employees for similar reasons. Dunning-Kruger effect in business and finance. The Dunning-Kruger effect can significantly affect financial decisions and investment strategies. Inexperienced investors may overestimate their abilities to pick stocks, analyze companies, or predict market trends, leading to poor investment choices and potential financial losses. This also includes a failure to recognize risks that may be present but are not recognized. People who overestimate their abilities may ignore expert advice, such as from a financial advisor, especially if that advice goes against their preconceived notions. Dunning-Kruger effect in medicine. This effect can lead to healthcare professionals overestimating their knowledge and making incorrect diagnosis or treatment recommendations. This can take the form of missing a critical diagnosis or failing to order the appropriate tests, leading to delayed treatment or even a misdiagnosis. This of course has consequences for patient care and health outcomes. How to avoid the Dunning-Kruger effect. To guard against Dunning-Kruger effects, it's important to seek out diverse perspectives, recognize one's own limitations, and be open to feedback and constructive criticism. Being both humble and realistic about one's actual abilities and knowledge may be difficult, but is critical for avoiding the pitfalls described above. Engaging with colleagues, mentors, and subject matter experts can also help build a more accurate understanding of one's knowledge and abilities and can help avoid costly mistakes. Don't assume that you are superior or know more than those with expert training and credentials in the field. Indeed, education and training are the best way to gain the actual knowledge base needed to make expert claims. Furthermore, healthcare organizations can establish clear guidelines and protocols for decision-making processes that individuals must follow regardless of what they think they know, and provide opportunities for professionals to collaborate and share their knowledge and expertise. What is the double curse of the Dunning-Kruger effect? Double curse of the Dunning-Kruger effect arises when low-skilled people greatly overestimate their own skills or knowledge. High-skilled people tend to underestimate their own skills or knowledge. Is the Dunning-Kruger effect real? Since the original study by Kruger and Dunning in 1999, several studies have replicated and supported the existence of their namesake effects across various domains. However, some scholars have questioned the statistical modelling used in the original study and criticized the over-application of the theory to a range of situations where it might not be relevant. Despite these criticisms, the Dunning-Kruger effect remains widely recognized as a genuine cognitive bias that can influence people's perceptions of their own skills and knowledge. What's the opposite of Dunning-Kruger effects? While there is no exact opposite to Dunning-Kruger effects, imposter syndrome may be used to describe the fact that highly trained and skilled people may underestimate their own ability or worth. Imposter syndrome occurs when those who are competent and accomplished nevertheless feel like they're frauds or imposters who don't deserve their success. This can lead to feelings of self-doubt, anxiety, and fear of being exposed as a fraud. That's interesting. I did not know that's called imposter syndrome. Or I did not know imposter syndrome was described like that. Okay, so who's the most susceptible to imposter syndrome? Imposter syndrome can affect anyone regardless of their profession, background, or level of achievement. However, it is commonly associated with high-achieving individuals, perfectionists, and or those in competitive environment who may become to doubt their own abilities. Bottom line, first identified in 1999 by a pair of psychologists, the Dunning-Kruger effect describes a ubiquitous phenomenon among people in which those with low skills or knowledge tend to greatly overestimate their skills and knowledge. Conversely, those with great skill or knowledge tend to underestimate themselves instead. The impact of Dunning-Kruger effect spans many domains and contexts, and in the world of business and investment can lead to poor hiring and promotion decisions, overconfidence, bad trading strategies, and excessive risk-taking, among other detrimental effects. To minimize the Dunning-Kruger effect, one can educate or train themselves to become an expert in the field, listen to knowledgeable advice and feedback, and be open to new ideas. Okay, so that's an interesting read there. What is a Dunning-Kruger effect? The Dunning-Kruger effect. Should you quit your job to trade stocks? Benefits of active traders who incorporate pre-market routine set stage for the trading day. A day in the life of a professional Forex trader. Needle and haystack stock message boards. You know what, this is interesting as well. Pre-market routine set stage for the trading day. Needle and haystack stock message boards. How much money do you need to start trading? Introduction to trading types, fundamental traders, beginner's guide to hedging, definition example of hedges in finance, trading account, definition, how to open and margin requirements, the roles of traders and investors, common investor and trader blunders, trading plan, definition, how it works, rules and examples. Is this about Forex or no Forex? Stock market. Okay. What is a trading strategy? How to develop one? Okay. Want to trade stocks in college? 5 tips to start. Cash trading, definition, rules versus margin trading. Trading effect, what it means, how it works. What is after hours trading and can you trade at this time? Is there a catch to free stock trading? What is spot trading? How do you profit? How it works? 20 rules followed by professional traders. What it takes to become an elite trader. The art of selling a losing position. Just do these two. Investopedia, anxiety index, Rio hedge. When to use fundamental, technical and quantitative analysis. Super trend indicators, what it is, how it works. Top technical analysis tools for traders. Top 7 books to learn technical analysis. Interesting as well. 7 technical indicators to build a trading toolkit. Best ways to learn technical analysis. Understanding basic candlestick charts. In there as well. Do that one. Most reliable indicator you've never heard of. Fundamental versus technical analysis. What's the difference? What is a candlestick pattern? Let's do that as well. Debunking 8 myths about technical analysis. Inside the rare but powerful triple tops and bottoms, technical analysis patterns. Average return, meaning, calculations and examples. Market indicators that reflect volatility in the stock market. How to build a trading indicator. How to use the moving average to buy stocks. Technical indicator, definition, analysis, analyst uses, types and examples. Metrics. What technical tools can I use to measure momentum? What is the T distribution probability? How do you use it? ETF analysis, the IPAF and S&P 500 VIX futures. Advanced candlestick patterns, do that. The rectangle formation, relative strength, definition, investing and stock analysis. Exponential moving average versus simple moving average, what's the difference? Using technical indicators to develop trading strategies. Industrial ETFs bounce off key support. Divergence versus convergence, what's the difference? Okay, let's work through these then. So, day in the life professional Forex trader. Professional status as a Forex trader takes years of commitment and is backed up by clearly defined strategies that show consistent profitability. But the rewards are worth the considerable effort. Professional Forex traders can earn a high income and a lifestyle that most folks can only dream about. Opportunities abound for these full-time players. They can choose to work for international banks, hedge funds, or just put on their pajamas and work out of a family home office. Let's look at a typical day in the life of a professional Forex trader who manages private accounts. These private accounts may include family funds or a share of other people's money. This is the goal for millions of at-home players who want to earn their living by trading currencies but without the restriction of a more traditional Forex workspace, like an international desk. Key takeaways. Professional status as a Forex trader takes years of commitment and is backed by clearly defined strategies that show consistent profitability. The professional Forex trader is usually forced to specialize due to the currency market's enormous complexity. Usually forced to specialize, so only trading one currency pair or something like that. Most US professionals starts with Euro USD and USD JPY, adding other pairs they fit into timeframes dictated by those popular instruments. Forex professionals hold a deep interest in economic and central bank policies around the world, understanding how the Federal Reserve, European Central Bank, Bank of Japan, and People's Bank of China impact currencies. At-home Forex traders can also use this guide to examine their current progress in creating their dream jobs within the worldwide flow of currency exchanges. Of particular interest, this article will cover workflows that traders can use for mornings preparation and end-of-day examination, attitudes, and strategies during the trading day that can impact performance, and lifestyle choices that can either assist or undermine. Defining market hours, the professional forex trader is usually forced to specialize due to the currency market's enormous complexity. In addition, this is a biological as well as logistical imperative. Forex trades 24 hours a day from Sunday evening to Friday afternoon in US time zones. This round-the-clock action makes it impossible to watch continuously in real time, encouraging a razor-like focus on specific time frames and currency and Forex pairs. Most US professionals start with Euro USD and USD JPY, adding other pairs as they fit into time frames dictated by these popular instruments. This often includes other Euro and Yen crosses, as well as AUD and CAD crosses. They choose wisely, often swapping out closely watched pairs over time because they understand that tracking too many markets will dilute the reliability of their strategies. Define market hours. Professional forex trader is usually forced to specialize. Tracking too many markets will dilute the reliability of their strategies. Euro price action picks up between 1 AM and 3 AM Eastern Standard Time. As a result, local professionals may get up earlier than equity or futures traders. This timing takes many of these folks out of the game after the New York lunch hour, triggering a noticeable drop in forex volume and volatility during the US afternoons. This lifestyle works perfectly in conjunction with the timing of key economic reports in Europe and United States, but it fails to capture Asian developments which can move world currency markets for months at a time. In general, this leaves two other specialization choices. Traders can match market hours with other US traders, aligning activities with the New York stock markets and Chicago futures exchanges. Alternatively, they may decide to bend the sleep cycles further, awakening for the Asian session and completing the markets day early after the US sunrise. In all specialities, professionals focus their efforts on currency pairs that provide the most profit potential for their strategies. This inevitably changes over time, forcing them to adjust markets at sleep hours to manage profitability. Professionals focus on currency pairs that provide the most potential profit for their strategies. This inevitably changes over time, forcing them to adjust market and sleep hours to manage profitability. Trading day. Trading screens are turned on soon after waking. So trading platform are turned on soon after waking, because currency markets are open and prices have been driven higher or lower during sleep hours. However, stress levels are low because well-trusted brokers are holding their capital, while carefully placed stops are guarding against outliers, like China's devaluation of the yuan in August 2015. Prices could have been driven higher or lower during sleep. However, stress levels are low because well-trusted brokers are holding their capital, while carefully placed stops are guarding against outliers like China's devaluation of the yuan in August 2015. In addition, they always review exposure at the end of the market day in order to ensure that losses taken during the sleep cycle fall within the confines of the risk tolerance. So, professionals always review exposure at the end of the market day, losses taken during the sleep, to ensure that losses taken during the sleep cycle fall within the confines of their risk tolerance. So professionals always review exposure at the end of the market day to ensure that losses taken during the sleep cycle fall within the confines of their risk tolerance. In the next video, we're going to carry on with research. See ya.